Hi, good afternoon, everybody. Welcome to our Power Hour. My name is Sean van den Berg. I head up client education. Welcome to our session on trading currency futures. This is a part two. This is following up from a session we had earlier in July. Here's the agenda for today. So those of you that are attending again, just bear with us. We are recapping for some people that missed it in July. But you can see also on the website, on the screen here now, there is a link to the July presentation, so we can go through that again just to recap. But I'm going to cover some of the stuff already, just to give a quick recap of what are currency futures, what are the pros and cons, and the risks in that. I'm going to spend about 10-15 minutes on that. But obviously the main presentation today is the mechanics, how do you actually start trading currency futures. So I'm going to be focusing on a very basic trading plan or game plan, and it's just the three questions you need to ask yourself regarding currency futures. What is the trend? Where's my entry and stops? And where's my take profit? So there's quite a few things to look at, so let's get started. Okay, hope you guys can hear me loud and clear. If there's any questions, please send them through. By typing a text, and then I'll try and answer it preferably near the end of the presentation, because most of the time I will be answering questions as we go along. If I can't answer your question on the webinar, I'll be catching back to you on your email. Also understand that I'll be sending the link to this presentation to you guys in a few days' time, as well as a recording. And if I can really encourage you guys to send me any questions you might have. Ideally, I'd like you guys to use our Facebook page or our Twitter page, so other people can get more involved, so we can use that forum more effectively. Okay, so let's get started. What I want to discuss today, as I say, is just highlighting again sorry, just go back to my pen mode here, the background. So I just want to tell you, obviously, some of you are trading currency futures already, some of you are quite new to it, some of you are just looking at it. Just understand the foreign exchange markets are big. Okay, they operate 24 hours a day. Just imagine when the markets open in the Far East, and as they close down, so for example, Tokyo winds down for the day, European markets start opening. And before the European markets start closing, the US markets are opening. And just before the US markets reaches their close at 11 o'clock our time, the Far Eastern markets reopen the doors again. So that's the kind of market we're in now. It's a 24-hour market. It's a very, very big market you're trading. We're talking about the spot forex market here. To give you some background information, way back in 1977, the turnover was about 5 billion a day. Now you're looking at over 3.2 trillion a day. So that's a very big market. Here in South Africa, the South African currency futures market has only been around for about 6 years. Began here in 2007. Back in 2007, the total value traded for the year was about 1.5 billion. Now we're looking at over 100 billion trading now, 6 years later. So it is growing in popularity. Obviously, the banks are the main players in the market and things like that. But the small private investor or the trader, excuse me, is getting more and more involved. So that just gives you a quick introduction to it. Let's go quickly through the mechanics, the details of what is a currency future. It's a standardized contract. So first of all, if it's standardized, it means it's regulated. So the JSE regulates it through its platform, through its Yieldex, or the SAFEX, through the South African Futures Exchange. So being a contract, being a futures, you understand that they do have a life. So every quarter, March, June, September, and December, they'll trade for that time period. And you close out a contract, and we go move into the next one. So right now, we are currently trading the September contract. Just understand the third Monday of every quarter, that's when we have the futures closeout on the currency side. Okay. When you're trading futures, currency futures, we understand one contract exposes you to 1,000 of the foreign underlying currency. So if you want to trade dollars, you're trading $1,000. We're trading euros, you're trading 1,000 euros. We're trading pounds, 1,000 pounds. Okay. So obviously multiply that by the current exchange rate, the rand rate, and you can see what your exposure is. Okay. So the price movement, 1 cent equals 10 rand profit. So or loss, if it moves against you. Just understand that these things are cash settled. They expire in rands. So that's a nice thing about this. You don't have to worry about getting tax clears, taking money offshore. You're always trading in the rands, and your money's always here. So there's no physical delivery of foreign currency. Okay, so no one's going to knock on your door with a big heavy suitcase handcuffed to his arm and say, okay, here's your dollars. There's no physical delivery. It's always cash settled in rand. So currency futures are geared or leveraged product. Okay, they can be geared up to 20 times, but PSG Online, we limit it to 10 times. We're managing risk to a certain extent there. Okay, so just remember the things are not rolled over. They have to be closed out on future closeout. That's automatic default situation. They automatically get closed out. Being a geared product, you only have to put down an initial margin, an initial deposit. You have the full exposure of $1,000 or £1,000. Okay, so that's where the gearing comes in. You're putting down roughly about 10% to give you that gearing of 100 times. 10 times or 100%. Just understand that the margin is split into two. We talk about initial margin. 50% goes to initial margin, and 50% goes to what we call a retained margin. The idea is that we use that as a buffer against mark-to-market movements. So compared to normal shares, you might have a paper profit, say for example 3 months, you got a 10% profit. Only when you sell that share will that money be in your account. Now when it comes to futures and to other derivatives, you must understand it's on a daily basis. Your profits and losses are in your account on a daily basis. So we use a process, first of all, what they call mark to market. It's a daily revaluation of all your open positions on the market at the close of the trade on that day. Okay. Remember, you're betting direction. Is the rand getting stronger or weaker? Dollar getting stronger or weaker? So as long as it's in your favor, the money goes to your account tonight. So that's where the variation margin comes in. So you have to put in that initial margin, okay, roughly about 10%, and that funds gets ring-fenced. You have to keep it at 10% all the time. If the market goes against you, you need to top up. So another way of looking at variation margin, I call it the top-up funds. And this is where the risk comes in. You can lose more than your margin. Please understand that. These things come with a wealth warning. I always joke, and some of you guys, the regulars know that I always joke about this, is that you can lose the wife, the house, and the car, not necessarily in that order. So these things come with a serious wealth warning. Okay. So just remember the risks. We'll talk about risks a bit later. Let's move on. So who trades currency futures? So you get a fund manager that has got an offshore portfolio. He wants to hedge himself. So you'd sell the dollar in case the rand strengthens. Imagine that. Now, remember the good old days when the rand was a strong rand? Okay, I don't think we'll see that for a while. Alternatively, a farmer or a manufacturer that is importing machinery from France or from Europe, he also wants to maybe hedge himself against a weakening exchange rate. So he'll buy a euro contract. And you'll see an example just now where we show you practically how this would work. Or investor, you got some rand hedge stocks, be it Sasol or Richmond, and you're scared that the rand's going to get strengthened. Again, you buy the dollar to protect yourself against that adverse movement against you. And most of the time we'll be trading currency futures as a speculator, taking advantage of movements. So for example, your view is that the pound is overvalued relative to the rand. You'd sell the pound relative to the rand. Okay, so you benefit from the currency exchange rate should this move take place. So those are just some examples. I know one of my colleagues, he's selling a CFA, and obviously that CFA is to pay for that course in dollars. So he's obviously looking at locking in, this is about a week or so ago. You saw that the rand's going to maybe weaken with its imminent strikes coming up. So you locked in these values. So there's a lot of uses. Okay. So that is just some background about who plays with it. At PSG, we trade 8 currency pairs. I want to highlight that word pairs. It's a currency pairs. There's always the dollar against the rand, or the euro against the rand, or the pound against the rand. So it's always against the rand. Okay. I've highlighted these 3 here in red because those are the 3 most popular, most liquid, most tradable, and obviously that's where the focus is. But you can also trade the Aussie dollar, the yen against the rand, the Canadian dollar, as well as the Swiss franc. Okay. You've got 8 different currency pairs. Over here it shows you 7. The other one is actually the Chinese one, but that doesn't trade very often. But so we've got 7 to trade with. Enough for you to make money out of anyway. So let's quickly recap an example of a speculative trade. Most of you will be doing this. So this is a normal futures trade. Okay, we call it a dollar bear in this situation. In other words, dollar bear, you're selling the dollar or you're buying the rand. Okay. So if you get a client, he's optimistic, he's positive about things, he's positive about the economy, And he feels that we'll start seeing more risk on. Okay, we'll talk a bit more about that term just now, risk on and risk off. I always see the Karate Kid, wax on and wax off, same thing here. It's that sentiment moves the market on a daily basis. Are we going to have a risk on or risk off day? Okay, so risk on environment obviously is where investors shy away from safe haven assets. In other words, they're moving out of the dollar, or they're moving out of the yen, and they're moving out of the Swiss franc. They're looking for more risky assets. And obviously the rand is regarded as a risky asset, being an emerging market currency. Okay, so risk on, I'm shying away from a safe haven. Risk on, risk off, I'm moving back to safe haven. Yeah, we will talk about it a bit more in more detail a bit later. So anyway, this client, he feels that the US dollar is overvalued. In other words, it's too strong, and it should depreciate. So you'll see on the next slide now, I'll have a bit of an Excel spreadsheet so you can see the flow of funds. On day one, the spot rates. So this is where the difference comes in now. We're not trading Forex. We are trading currency futures. So, but it's always important to have a view on what's happening, or have an idea where the spot rate is. So the spot rate in this situation is trading at 10.20 to the dollar. The futures price is obviously trading a bit higher. That's including obviously interest. Remember, I'm putting down 10% to borrow, and I'm borrowing the other 90%. And obviously that includes interest, as long as depends how long I hold the contract for. Remember, the maximum I can hold is about 3 months. So obviously that higher future price, remember, it includes interest. We call it forward points. But anyway, you be trading at that 10 Rand 32.34. So he wants to go, he goes and sells 100 contracts, a September contract. Remember I spoke to you just now about trading September contract? That's how to be called. It's called September 13th. You know, it's a Monday the 13th. And then obviously that would be the futures closeout. So anyway, he goes and buys 100 contracts at 10.3234 against the dollar. The margin, remember I spoke just now about the initial margin, the initial deposit. In this situation, it's 900 Rand per contract. This is for the US dollar. He's buying 100 contracts, so 100 contracts times is 900 Rand. He's putting down an initial margin of 90,000 Rand. Okay, so you might think, wow, that's hectic. But remember, he's taking out 100 times that exposure, so it's obviously much more. Okay, more than R1 million. He's bringing down 90,000 Rand as a deposit. So that's where the gearing comes in. But if you take it down smaller, let's say, for example, you haven't got the funds available, you go buy one contract. One contract's going to cost you 900 Rand. Okay, so that's your margin. So they're very capital efficient. Secondly, obviously, they're very cheap. Your brokerage is only 18 Rand per contract. So in our situation here, he's got 100 contracts times these 18 Rand. His brokerage as such is going to cost 1,800 Rand to open a position. Okay. So remember, you open up a position, there's the brokerage, and when you close the position, again, there's brokerage. So in this situation, obviously 1,800 Rand to open, 1,800 Rand to close. Okay. So he, in this situation, pays the margin over to clients, to PSG, which is 90,000 plus he pays the brokerage. Okay. That deposit, by the way, that 90,000, it's always your money. Remember, it's a deposit. So you're earning interest on that money anyway. We just hold it as collateral. That's what we're doing. Okay. So remember, you're earning interest on that money. Guys, I hope you guys hear me clearly. Just remember, any questions you have, just type them up and I'll try and tackle them a bit later. Don't see any questions yet, but I hope you guys are hearing me loud and clear. Okay. Okay, those of you guys who are still joining us, latecomers, welcome. Remember, this presentation will be sent to you guys. I'll be sending you the link, and also as well as the recording. Okay, so let's go back to our example here. On day 4, the spot rate is now trading at 10 Rand. Remember, he bought it at 10.32. Okay, obviously that's 10.20 was the spot. The future now is trading obviously a bit lower because remember you said you was expecting it to get stronger. So he goes and buys back the contract. Remember, he sold it at a higher price. Now he's buying it back at a lower price. He makes the difference up. Okay, so he buys the contract back at that 10.12.34. Okay, and that's where the difference comes in. So in this situation, his gross profit is 20 cents per contract. So 20 cents times his 100 contracts, times the 10 Rand per point, he's got 20,000 Rand profit he's made. That's a gross profit. Less his brokerage, remember, in and out, 3,600. So he's got a net profit of 16,400. As I say on the next slide, you'll see the actual the flow of funds. So remember that initial outlay of 90,000, it's returned to you, okay? Obviously with the interest and things like that, but also you made 16,400 rand as a return on that 90,000. So effectively your return is over 18%, which is not too bad. If you look at the rand, it's only weakened at 2.4%. Remember the dollar has strengthened, obviously the rand is weakened. One thing I certainly guys want to realize is that those of you that are day traders, you want to get in and out the market within the same day. You open and close the position within the same day. You only pay brokerage on the one leg. So in other words, in this situation, if you had bought and sold on the same day, okay, so 4 days later, you bought and sold in 4 days, and this is very easy to do this, where the market moves 10 or 12, 15 cents in one day, especially with the volatility right now. The guys can't do that. But anyway, you only pay brokerage on the one leg, so that you're saving yourself 1,800 rand in this situation. Now, as a percentage, obviously, that increases your net profit and obviously increases your return. Okay, so here's our example. As I mentioned just now, we start on day one. Let me go back to my little spotlight here. There's our initial margin. Okay, so 90,000 rand for his 100 contracts at 900 rand per contract. There's his brokerage. That's the price he traded at, 10.3234. Okay. Mark to market, last 10 minutes of trade, between 10:55 and 5 o'clock, the JSE will take an average of the price, okay, of what's happening with the rand. And that's where we talk about mark to market. Okay, now he bought at 10.32, now 10.25. The difference, that's how we get the 77 cents. You can say just over 7 cents, 7.3 cents. Okay, times my 100 contracts, okay, 73 rand times, times the pips. Okay, times the contracts, times 10 rand per contract. Okay, so in this day, after brokerage, on his first day, he had a net cash flow of 5,500 rand. And so it goes on every day. Day 2's got a net cash flow of 10,000 rand. On day 3, however, the market goes stronger, goes against him. Okay, remember we're at 10.15 and now the market goes up, gets stronger. The rand weakened and the dollar strengthened. Okay. So the market goes against him. So in this situation, 8,000 rand went out of his account that night. So remember, this is the difference between equities and things like that, where you have a paper profit. With derivatives like currency futures, you have a variation margin, money going into your account and out of your account all the time. The bottom line, after day 4, if you had to add these 3 columns up, bottom line, that's how you'd make that 20,000 rand. Okay, sorry, your 16,400 after cost. Okay. So guys, when you get this presentation, look at this little Excel spreadsheet, give you a better idea. First of all, obviously, margin movement, the brokerage, and also market to market. Those are the 3 main concepts you need to understand. Okay, so what are the benefits of trading currency futures? Obviously, the tight spreads and low trading costs. This allows you to enter and exit positions knowing that the profits are not going to be paid away, okay, obviously, on your account. So you know what you're getting. So that leads to the third point there. You have transparent pricing. It's real time, and it's at the JSE, so it's central order book. Okay. A cheap, 18 rand per contract. Okay, very, very cheap. Remember, that includes settlement and all those other little costs. Okay. And obviously, I only use the example now as a speculator. Those of you that have share portfolios or are looking at hedging yourself, be it that you're an importer or exporter, use currency futures as a tool. Okay. So just understand that mark to market is a daily process that allows you as a client to track your profits and losses and obviously adjust your portfolio accordingly. So obviously you haven't got the cash available in your account and there's a margin call. In other words, you need to top up. We're there to help you. Okay, in the sense that give you a chance to deposit by 3 o'clock in the afternoon to cover those losses and things like that. So we send out on a daily basis. Obviously, we send out your trading statements and things like that. Obviously, showing your margin and cash movements and things like that. So there are a lot of benefits to trading currency futures. I think the biggest disadvantage, if you had to look at it that way, is point number 4 here. Being a geared product, yes, it can be risky if you don't know what you're doing. But just think of the other side. The positive to me is that it's very capital efficient. I don't need to put down a full value. I don't have to put down 10,450 rand to have exposure to $1,000. I need to put down 900 Rand. That's what I love about this. It's more capital efficient. I can use more funds for other positions and things like that. Okay. So guys, that is, as I say, a very quick recap. There's a few more slides just to orientate you guys back into this again. Just understand there are risks involved. Being a geared product, obviously you can make large profits, have a small capital outlay, but if the market moves against you, or trade moves against you, you can incur large losses. Okay, so this is where my disclaimer comes in. I'm telling you, be careful. So you can lose more money than you actually investing. So it's not for everyone. You need a high appetite for risk. You need time to be watching the markets. This is not something you buy and forget. Okay, you need to be watching this all the time. Obviously, you also need some expert knowledge. So after today's and obviously the review of the previous presentation, you'll have a better understanding of how the currency markets works and obviously the trading processes. So that's what those are the three things you need. So as I say, it's not for everyone. So you need to decide, is it suitable for you in light of your personal circumstances and obviously your financial resources. Okay. There are a lot of factors involved, and we'll go through these just now with the trading plan. You have to take into consideration volatility and exchange rate risk and credit risk and monetary risk. And look at what's happening right now with America. There's a possibility of military intervention now in Syria. So everybody's on tenterhooks. There's a lot of uncertainty. All those kind of things you have to have a view on. So experienced traders will learn to evaluate these variables and take in consideration. So that's also maybe one of the reasons why our rand is weakening right now. And with any technical analysis, you trend your friend. You trade the trend. Okay. So not every trade will be successful or profitable. That's part of the game. What's important is for you to obviously minimize your losses. So what's a good idea to also to do is have a target price or a profit target in mind. We'll talk about certain ideas and tools to use just now. But the idea is to plan the trade and trade the plan. Okay. So be strict and be diligent. Stick to the plan. That's where the discipline comes in. We talk about the 3 M's, methodology, mindset, and money management. Money management to me is the most important. But also, mindset's important. So do not let your emotions rule. Trade on the fundamentals. Trade on the numbers. Okay, so it's to have a documented or detailed plan, and we'll talk about it just now. So it's just a strategy that you want to follow. So it's, sometimes you might be in a situation when you're in a profitable trade and you're going to milk this trade, and you're going to stay in this trade as long as you can, obviously for larger gains. And this is where the emotions come in. Greed and fear are the two biggest enemies. But this can go against you, and this is where your long-term profits can become short-term losses. So be careful. If you hit your target price, get out. You're happy. You stuck to the plan. Okay. So let's quickly go through how it would work. To open a position, obviously you deposit a margin. Understand that on a daily basis, it's mark to market and there's variation margin. Okay. So again, I'm helping on the leverage, because understand that you're trading a small amount of funds, but obviously geared up 10 times. So be careful of that. Okay. So this is what our trading platform looks like. A PSG Online, the currency futures platform. So obviously you need to register and open up a single stock futures account with linked to a currency futures account. So you might not want to be trading single stock futures now, but maybe later on. But the currency futures account are linked to single stock futures. Okay. So anyway, yeah, I'm in the situation now. I want to go trade the US dollar. As I say, it's a September contract. So I click on load and it loads up. This is what I did on Monday. So you can see this is when the rand was still around just about 10.28. Since then it has fallen. Anyway, on the left-hand side you've got the buyers, the bids. Okay, these are all the buyers in the market. And on the right-hand side, the offers are all the sellers in the market. And you can see also here in your account information, the system will tell you what's the margin required. Remember, that's a 2 times 450. That's a double margin. So the initial margin plus the retained margin that the JSE requires. But let's talk about the bids and offers here. This second line here, remember most of the market players when it comes to currency futures are the big banks. Okay, they are the main players. But yeah, let's look at this here. Remember this volume, that is the number of contracts. So here we're talking about 500 contracts that is being bid at 10.28.97. For this order to be met, okay, the sellers have to come right down and meet that price, okay, at 10.28.97. So it's exactly like a share. We need a willing buyer and a seller to agree on price. Okay, so that's on the offer side there. Sorry, on the bid side. On the offer side, you can see also that's 1,000. That's 1,000 contract sets. So most of the time, as I say, it's usually a bank. So let's say, for example, you decide, okay, you want to go sell the pound, the US dollar. In other words, you anticipate the rand to get weaker, so you'd sell the rand. Okay. So remember, if I'm anticipating that the rand's going to get stronger, okay, I'm going long, you'd buy. If I anticipate the rand get weaker, I'd sell. So that's why I put this little thing at the bottom here, just to help you understand which way the market's going. So again, I want to highlight it's currency pairs. Ask yourself that question. What do I anticipate? I anticipate the rand to get weaker. So if the rand's weakening, I'm anticipating the dollar to get stronger. Okay, or vice versa. I anticipate the rand to get stronger. On the other side of the coin, will the dollar weaken? Okay, in the current environment, I anticipate more risk off. There's a flight of capital out of emerging markets because of the situation in Syria. So there you find more dollar strength. Okay, so I'll be rather selling the rand right now. And also the scenario of the strikes. So all those kind of things play into it. So in this situation, I'm really just simplifying it. I'm going to go by one contract. Remember, that one contract is equivalent of 1,000 of the underlying. In this situation, $1,000. So $1,000 times my 10 rand 28. Okay, in this situation, 10.29. I'm spending 900 rand to have exposure to 10,290 rand. Okay. So remember, when you're pricing the price here, it's always in rands. So there's a decimal point somewhere. Put 10.00 or whatever the case might be. Remember, it's always in rands. I click on submit, goes into the order book. Obviously, I need a willing buyer and a willing seller. Depends on which way I'm trading, the direction of the market. Next minute, I've got the transaction. I'm in the trade, and it'll be reflecting in my holdings. Okay. So the idea is to go for at least 10 to 15 cents per day. That's what the guys will do. After cost, remember, I'm looking at 18 rand in and 18 rand out. So times 4 times the 10 rand in cents. The share has to move, or the index the currency future has to move 4 cents to cover those costs in and out the market. If you're looking at a swing trade, more than 2 or 3 days. If it's a day trade, remember I'm looking at 2 points, 2 cents to cover my costs. Okay. So guys, that is a quick recap. Let's go into part 2 where I want to talk about the trading plan. There's 3 questions you need to ask yourself quickly. You need to ask, what is the trend? Okay, and that's where the analysis comes in, the fundamental analysis, and there's quite a few factors we're looking at. Quite a few factors, and also quite a few economic data you need to be aware of, and obviously tools to use to help you make a decision. And obviously you can also use technical analysis. Being technical analysis, being a technical analyst, I prefer to use the charts to help me in my decision making. But that's only the one side of the equation. Remember, that's a methodology. What's also important, you need to look at money management. So first question I always would like to know is, where's my stop loss? If things go against me, where am I getting out? So that's the first question I always ask myself. Where is my stop loss level? Okay. First point I ask myself is, where is my entry level? Where will I get into this trade? At what price? And up to what price am I willing to pay? Okay. And then the third question is, you need to know a target price, a TP. Okay, take profit or target price. Or other words, a lot of people, we talk about an exit level. So those are the 3 questions you need to answer. Let's go into these questions into more detail. To answer the question, what is the trend? We talk about trend analysis. This is where you use, you're trying to establish or predict the movement of the market. When I say the market, obviously the currency market. So the idea is to determine, are we in is the trend bullish? Are we have rising prices? Or we have falling prices in a bearish trend? So that will help you decide whether to buy or sell, whether to enter or exit the trade. Okay. So let's talk about fundamental analysis. A fundamental analyst is someone that follows a lot of economic data. So you'll follow macroeconomic data of the countries whose currencies they want to trade. And the goal obviously is to determine the trend and direction of that currency. So the main idea is that obviously these fundamentals do affect sentiment. Sentiment is what moves the market. In other words, for sentiment is emotion. Market is yes, to a certain extent is conducted by machines, by computers, but there's still lots of human intervention there, and humans are emotional and that's where what moves the market, emotions. But you want to look at the flow of money. So you need to understand how money moves from developed markets to emerging markets, and from emerging markets back to developed markets. So obviously now we can see the strength of the rand or the weakness of the dollar, etc. But also from fixed income securities to equities, and from equities back into fixed income. Those are the flow of funds. That is our goal, flow of money. Okay, let's move on to, we spoke just now about risk on sentiment. This is where, remember, investors are bullish. Risk on, I'm bullish. I want to invest in riskier assets. So obviously emerging market assets like South African equities or the JSE is obviously in demand, but also obviously the rand, because I have to convert my dollars into rand. So risk on or bullish view is good for a stronger rand. So remember, they're shying away from the bonds and the equity markets in the States or in Europe. They're moving out of developed markets into more the undeveloped or emerging markets. You're looking for something that's got higher risk and higher reward ratio. That's what the guys are looking at, in a risk-on environment. Okay. So South Africa is a favorite amongst all the emerging markets destination as a destination. Obviously, our equity market is regulated and there's opportunities there. But if I get involved in the South African market, I have to sell my own currency and then I have to buy the rand. That leads to, as I say, rand strength. So just to understand, risk on is good for rand strength. Other side of the coin, risk off. This is where I'm bearish. I'm bearish in my view. I'm negative. I shy away from riskier assets like South Africa and China and Brazil, etc. I'm taking my money back home. That's what I'm talking about, risk off. I'm risk averse. Okay, I want to go back to safe haven. So safe haven can be the US Treasury bills, can be the Swiss franc, can be the US or the Japanese yen, whatever the case might be. Okay, so if I want to get out of my JC shares, I'm American, I want to convert my shares back into dollars, I have to sell, okay, the shares, and obviously convert from my rands back into dollars, and that leads to rand weakness. So I'm just trying to get you to understand the chain of events. Okay, what happens? What happens? What's the implications? What's the implication? What's the effect? There's a cause and effect on every situation. Okay, so that's just risk on, risk off. Let's talk about economic data. Every Friday, usually Thursday and Friday, we always look at economic data, employment data, especially from the States. Remember, the States is the gearbox of the global economy. So strong employment data, it means more people are being employed, it means obviously the economy is growing, it means risk on. Okay, let me move my money offshore. I'm looking to take for a higher return. So obviously you'll see a strengthening rand, so you'll go long or you'll buy the rand. If it's weak employment data, obviously the economy is not doing so well, you have more risk off, and you see weakening of the rand, and obviously you'll be selling. So I'm showing you the opposite. I can always say vice versa, but I want to write this out for you guys so you can see that scenario. Consumer data, our economy, for example, is very much consumer driven. That sentiment is important. Same as the American economy. They need the consumers to be spending money. So if there's strong consumer data, they are going out and purchasing, and there's a lot of increased sales. That's again risk on, good for the rand. Weak data, bad for the rand. Retail sales, very much obviously linked to consumer confidence. Remember, consumer confidence is just the outlook for the market. Retail sales is practical. You've actually seen the sales coming through. Increased sales, retail sales, risk on, weak retail sales, be risk off. Manufacturing data, they call PMI, Purchasing Managers Index. There's more things being made at the factory as such. You want to see that's economic growth, risk on, and obviously, so we go and move the whole range show again. Okay, so that just gives you some background. Obviously, there are more. One of the things I always find interesting is to look at a thing called the dollar index. Now, this measures the performance of the US dollar relative to a basket of other currencies. So again, you have these two scenarios. If that data shows that the dollar index is trading up, the trend is up, that's basically signaling that investors are increasing their appetite for the dollar. If they're increasing the appetite for the dollar, it means they're selling off emerging currencies. Just think of the opposite. So this may be a result of them buying dollar-based securities, be the bonds or be the shares. So money is being repatriated. They are seeking a safe haven. This is a risk-off environment. Remember, risk aversion. You see the dollar index going up. This is risk aversion. I'm preferring the dollar. So obviously, the opposite of it. If dollar is increasing, means that the rand is weakening. So just the inverse again. If you see that index is trading lower, obviously be the opposite. Okay. So you can go Google dollar index. This is just one website that I came across this morning. This is just using 15 minutes delayed or 15 minutes or so, but you can see the trend. Okay, it's for a long time there was support. We broke through that. Obviously, that is risk off. This is risk on. Okay, sorry, risk on. That's risk off. The trend is up. That means that the increased appetite for dollar. That means rand weakness. So it's just a tool to help you understand also which way shall I go. Shall I buy the rand or must I buy the dollar? Okay, there's a tool you can use. Other important economic data you can use. Go to these lot of websites. You'll be able to get access to the US Treasury bill. Remember, this is a government bond. So here you're looking at interest rates. Okay, if the yields are decreasing, that means the trade is down and signals that the investors are buying the bonds. Okay, this is run to safety. That's safe environment. It's a risk-off environment. Remember, risk aversion. So obviously this would usually equate to a weakening rand. Here closer to home, you can use the R157 or the R168 or all those other bonds and such, also to give you a view on where the market's moving. Remember, this is moving from fixed income securities into equity markets and vice versa. But if you see that the yield starting to decrease, that means that the rand will be strengthening. There's demand coming in, obviously converting it over from dollars into rand. The rand should be strengthening. Okay. And obviously our JSE can also be a barometer. You see that there's exactly what happened this week. On Monday, the JSE Top 40 Index made new highs. Okay? And that I found interesting because we were making new highs despite our rand trading at 10 Rand 28. Okay? So obviously we had a lot of guys coming in to buy our rand hedge stocks, for example. And since then, obviously, we've got the opposite. There's been a lot of profit taking. The rand has weakened further in the sense that the foreigners are converting their rands into dollars and pounds and things like that. But the JSE has also fallen back the last 2-3 days, okay, on profit taking. So it's also a good indicator of which way the market's going. Let's look at more important economic data. We talk about gross domestic product. I think it's either today or tomorrow. Tomorrow our GDP data comes out. Obviously, that's our economic growth. If there is positive growth, that sounds like the economy is growing. Obviously, it will cause investors to take on more risk. They'll feel more bullish. There's that sentiment. And obviously, they'll go out and go buying to the share market and obviously pushing the price higher and obviously spurring other investors into the market. But also, it's important to follow what's happening in Europe, especially what's happening with Germany. Obviously, that's the biggest economy within the European Union. You want to see growth. If the economy is growing, it means that the euro and that will also get stronger as money flows into those economies. You can also look at what's happening in Asia, India, and China. Okay, sorry, USA, India, and China. CPI, consumer price inflation. Obviously, increasing or high inflation is not good for investments. So it obviously eats away to your profits. So people prefer a low inflation environment. Obviously, governments would use interest rates as a mechanism, as a tool to reduce inflation. So we're in a situation right now. Obviously, the oil price is higher. I saw this morning 117. You can imagine what's going to happen with the price of petrol next month. It's going to skyrocket to new record highs. That will have an implication for inflation. So it's going to get to the stage one of these days that Joe Marcus, the Reserve Bank governor, has to start raising interest rates. And as interest rates go up, it will be negative for the market. But however, saying that, as interest rates go up, you'll see in the next slide, that is positive for the rand. Okay. Why? Because our interest rates are higher than our trading partners. It's an incentive for them to come to invest here. Okay, so let's talk about interest rates. Interest rate cuts and interest rate hikes. Okay, currencies follow and seek higher interest rate zones or countries with higher interest rates. So it's more commonly referred to as carry trade. But an interest rate hike in South Africa will be rand positive. Whereas an interest rate cut, and I don't think that will happen right now in our current environment, to try and stimulate the economy. No, I don't think it will happen right now. you might just keep interest rates unchanged. Just understand there are implications. There is a reaction. So interest rates are usually lowered to free up money and obviously boost economic growth. You've got more money in your pocket. You have to pay interest on the credit card or the car payments or the home payments. You go out and spend it. So usually it'll be positive for the rand because obviously you as a consumer will be spending that money. Consumer stocks, share prices go up, and obviously that's where it all flows from. Just to understand also our interest rates, okay? The South African interest rates, we're at 30-year lows. We're trading roughly about 5% on the repo. Okay, primary interest rates around about 7%. We're at 30-year lows. Compare that to the UK, where they're about 0.5%, and Europe, where they're at 0.75% of the interest rate, of a percent. Okay, so we still offer a very attractive return to investors at these rates. So imagine if interest rates had to go up to 5.5% or 6%, our rand will get stronger. Maybe that's what we need. Okay. There's also some important commodities to follow. What's happening with the gold price? Remember, it's a safe haven asset. It's one way to protect your money against uncertainty. It's a risk-off environment. And the idea is that obviously you'll be buying into gold to protect your funds. But obviously everybody's moving out of paper, they're moving to gold. That'll be weakening of the weakening rand. Copper is also always associated with industry and production. So strong manufacturing or production data together with GDP data usually points towards a growing economy. And obviously everybody needs copper, and that's where the prices will go up. So that's just a way of just tying all these things together. For every action, there's a reaction. Okay. So, let's quickly talk about technical analysis. We spoke about fundamental analysis, let's talk about technical analysis. The idea here, remember, we're trying to evaluate market prices based on historical price patterns. I'm using historical data to help you anticipate future trends. So there's various indicators you can use. I'm just using two in this example just to get an idea across to you guys. I'm going to talk about the MACD and the overbought oversold indicator. Okay, so let's go quickly into MACD. MACD stands for Moving Average Convergence Divergence. So MACD is the difference between two moving averages. But the idea is that you want to use the moving averages to help you determine a new trend. Are we bullish now or are we bearish? Okay. So these two moving averages, remember, some of the moving average of price, it's a difference between a 25-day and a 12-day. Creates a third moving average. And what happens, the system automatically puts a fourth moving average on top of that, what we call the fast moving average. Okay. The idea is that these two moving averages come together, okay, they get closer together, they converge, or they widen, they move further apart, and that's what we call divergence. Okay, you'll see a graph just now when I show you the actual chart, what it means. But the interpretation is such, remember, as the slow moving average and the fast moving average approach each other, that shows you there's a potential change in direction approaching, a potential change in trend approaching. Okay. So the trend changes, obviously, is when the two cross each other. That gives you the signal. So when the slow is above the fast-moving average, we have a bearish trend and vice versa. Same as also with the trading price. The currency is trading above the MACD, it's bullish, and when it's below it, it's bearish. But I think the best way to explain this is to actually look at the chart. Here's MACD. This is using our WEN software. Again, I'm using long-term moving averages, 200-day moving average to help me establish long or short positions. And then I overlay it on top of this. I've got a 10 and a 30-day. It doesn't matter what you're using. Okay. What's important, and obviously in our example here, we're looking at the MACD. That's what I was talking about just now. The difference between a 12-day and a 25, and then your dotted line is your 9-day trigger. Okay. So yeah, we've got the prices trading above the moving average. If it's trading above the moving average, the trend is bullish. You can see the trend is up. Okay. The other trend is trading below those moving averages, the 10 and 30-day moving average. Okay. And the trend is bearish. We've got a downtrend. Okay. What I find interesting now, combine that now with a MACD indicator. So it's an oscillator, moves above and below a zero line. Okay. So when this fast moving average is trading above the slow moving average, the trend is up, it's bullish, okay, and vice versa. When this dotted line is trading above the fast moving average, okay, we have a bearish trend. The ideal situation is when the two of them come together. Like I've got there, with that little highlighted by that alert, that would be an ideal situation to buy right at the bottom here. And lo and behold, it's also bouncing off that 200-day moving average. We talk about support and resistance just now. Your support and resistance, or your trend line acts like a support and resistance line. Sorry, your 200-day moving average. Okay. So these are tools you'd use to get in and out the market. Okay. Now one step further, you can use a thing, an indicator called overbought, oversold. That's the actual indicator. This obviously helps you determine if the market's due for correction. A sharp up movement over a very short period of time, we call that being overbought, and obviously the opposite is a sharp down movement will be called oversold. Just understand this, the difference between the moving average and the price. So it's important to compare apples with apples. In this situation, my overbought, oversold indicator, I'm using a 21-day period. It's important also to compare it now to a 21-day moving average. This is a 21-day moving average here. Okay, that's your purple line there. So it's an oscillator, again, moves above and below zero line, indicates we're above the zero line, would be overbought, anything below it would be oversold. Okay, so yeah, we are extremely oversold. You can see that, okay, obviously we're a bit further there, but we're at the bottom of the cycle. That's what you're trying to determine, are we at the bottom of the cycle? Okay, when it goes up to a zero line, that's when the share price and the moving average are equal. That's why we got to that zero line. So there we go. When the share price crosses, or in this situation, this is the US dollar. When the US dollar crosses this 21-day moving average, that's will be the same thing here. Okay. But we've moved from an oversold situation to give us a buy signal. Okay, the trend is doing bullish. You can also use other indicators. And the ones I use a lot is the RSI. I also like the slow stochastic. Very similar. Instead of having a zero line now, we have two zones. On the stochastic, we talk about the anything above 80 will be overbought, anything below 20 will be oversold. Okay, on RSI, anything above 70 will be overbought, anything below 30 will be oversold. Okay, what I always like to do is that's the scenario when the two of them confirm we're both oversold. So we're near the bottom of the cycle. So you want to trade that little scenario there. Okay, we're oversold, we're below our moving averages. So the trend is bearish. Put a criterion that you'll get in to trade that rand. Okay, so you can get in a bit high if you want to. The two of them cross here, and that's where the moving average will cross the gap. So that's how you'd use it all together. But this is a methodology. Let's talk about other things now. How would you know when to get in and when to get out? And this is why I prefer to use support and resistance trend lines or support and resistance levels. So resistance level, what it is, we've hit a ceiling and the market doesn't want to trade above that level. Okay, we call that a resistance level. Alternatively, the price has fallen. Okay, we don't go below a certain level. It's like floor. Okay, that's what we call a support level. So obviously you'll have various levels. If it's broken through level 1, broken through level 2, broken level 3, you know, you got a trend. But also you'll find that sometimes the market turns around now and starts trading back to where it came from. And by the way, you don't have to worry about this too much. Weather Rand report goes out on a daily basis. We cover all the relevant and resistance levels for you guys. So you compare it to your own analysis, your own strategy. Okay. This is what it looks like. This is the rand relative to the dollar. I like to use horizontal trend lines. You can see it's hit there. That's a resistance level. That's a resistance level. That's quite a few times. Eventually we break out. Okay. But remember, a previous resistance will become a support level. That shows you that this was a very, very important resistance level. So it broke out, and also you can measure the distance between here and on top. That same distance will be your target price. This is the ideal situation you're always looking for. So I'll bring in some chart patterns into it. This is what we call a rectangle. So there's my breakout. That would give me the interest situation. Where would I go to? I work out the difference between the two of them, between 8.45 and 8.10 of the 35 cents. Okay, so I add 35 cents onto my entry level, and that's where we're going. Okay, so it gives you a possible target price to go for. So I'm eliminating the human emotion. There's no more guesswork. This is where I'm going to. So yes, in a very short period of time, it went up, and we actually gapped up. When you see gaps like that, that's sentiment going crazy. And then the market eventually pulled back to retest that previous resistance trend line, established a support line, see it touched twice, and from there we resumed the trade. You see, again, sideways market touched a few times, and most recently we've broken up above this 10 Rand 20 level. Okay, that was a very psychological level for a long time, 10 Rand 20. We've broken up above that now, and I saw this morning we're heading towards 10.50. Okay, we broke at 10.50, we're heading to 11 Rand. And so it goes on. Okay, that's against the dollar. Let's talk about the euro. Okay, now I'm using a bit of some vertical trend lines. Okay, you can also bring in other little trend lines. You can start looking at little patterns, chart patterns that we call triangles. I can measure that distance between the low and that high there, and from the breakout, that's my target price. Okay, whatever that level was, you can imagine you can extrapolate another support trend line here. That would be my support level over there. Okay, my target price. We've gone up much higher than that. And most recently, again, we've broken up above this resistance. We've gone to retested it. We've broken up above it. So our previous resistance will be support. So there we go. Those of you that want to trade the Rand right now, you should be more at selling the Rand, anticipating a weaker Rand. This is against the Euro. We're heading towards 14 Rand to the Euro. Against the Pound, we've broken up above 16. We're on our way towards 16.50 and towards 17 Rand. Okay. So that gives you that kind of view. That's when you enter, once you have established the trend and direction, you establish your entry level as such. Okay? What's the best time to get in the market in a bullish trend is to buy in the dips. Okay? And obviously a bearish dip, you want to sell the spikes. So what is a stop loss? The idea is when the market goes against you, you need to cut your losses quickly. So what's a good level to set it at? It's a breaking of a previous support or resistance level. So if I'm going to go back to the previous slide, that is my previous resistance will become support. If I'm long, short on the market, if it breaks through that level there, I'll close out my position. Okay, so that's exactly where I would put my stop loss if I was short of the Rand. Okay, because obviously the trend is reversing. So use your support or resistance lines. In other words, use the charts to tell you where to put the support and resistance level. Bottom line, guys, the Rand report of gain will guide you with those relative stop loss levels. Okay, so where would I get out? Use those support and resistance levels, ideally rectangle situations or chart patterns to help you establish where the market's going. But again, we'll give you in our Rand report, and you can find it on our website under the on the news blog. You'll find the Rand report every day. Once you sign up for the currency futures account, you'll automatically get emailed the Rand report on a daily basis. Now it's a tool you can use to make decisions. So anyway, your profit targets will be in your Rand report on a daily basis. So where do we go from here before we get into some questions? Those of you that never traded before, I suggest your first investment is to educate yourself. Understand the product. What are currency futures? So please review this presentation. Guys, I hope you're hearing me clearly because it's got a little pop-up here that there might be some connection problems. I know we have suffered some power failures today here in Bryanston, and I know we had some server problems, but I hope you guys can hear me loud and clear, and I hope this recording is coming through. So, remember, your first goal is to educate yourself, understand the contract details, understand how margin works and things like that. You need, if you want to trade currency futures, you need a tool called technical analysis. You need some charting software. I suggest maybe look at our software, our web, if it's for free, or you subscribe to the download service. It's 169 Rand per month. But you've got all the classical, traditional indicators in it. You'll also be able to draw your trend lines and things like that. Remember, it's end-of-day data. Most of you will be doing what we call swing trading. Unfortunately, we don't have a currency futures simulator at this point in time, so what I suggest you guys do to learn about currency futures is the paper trade. Open up an Excel spreadsheet for yourself, use that example I was using earlier on, understand when to buy and sell, the spot and the futures price, your margin movement, understand how brokerage is calculated. Your goal there is to gain confidence. Are you betting in the right way? Are you getting the trend right? But also understand how margin is moves in that your account, understand how mark-to-market on a daily basis is also calculated. Okay. It's important to start creating a detailed trading plan. What is your entry, stops, and profit levels? Okay. Then lastly, it's all very well to have all this theoretical knowledge. If you're not going to do anything about it, remember, you need to put it into action. Open up that trading account. Start trading with us. Start small. Go buy a $1 contract. Remember, your margin's only 900 Rand. Start slowly. Remember, you want to gain confidence and then slowly, obviously, build up from there. Okay. But it's a great way to learn about the market, and these things are fun. And you can make a lot of money in a very short period of time. Obviously, on the other side of the coin, you can lose a lot of money if you're not watching it. So it's very, very important. Risk management, money management, very, very important. Okay. So quick summary, understand the mechanics behind it, and just quickly before we any questions, obviously ask those 3 questions the whole time. What is the trend? What is my entry? What's my stop? So there's no rocket science to this. It's very, very simple. And the idea is to keep it simple. KISS. I believe in keeping it KISS. Keep it simple, superstar. Okay. I prefer that version than the other one. Yeah. So guys, in conclusion, please review this information on our website regarding currency futures. But please go through this presentation when it gets emailed to you. Go through the webinar recording. Email me any questions you might have. But also, I prefer, if you could, go to our Facebook website, Facebook page, and go post your questions there so everybody can learn about it. The guys stuck there in Kuruman, the guys down in the middle of the Free State, they can have access to this information. Okay. And then from my side, obviously, go open up that single stock futures currency account today. Okay, obviously just do it once. There's no admin fee involved. If you're an existing client already with us, equities, we got your FICA ready. Okay. So guys, from my side, good luck and happy trading. There's my my email address and there's my contact number. So let's see if are there any questions coming through. As I say, if I don't answer it here, I can always be answering to you guys a bit later on email and things like that. Okay. No. You guys are clever. No questions coming through. Okay. Anyway, guys, if there's any questions, you can always email me. But thanks for your time. Thanks for supporting us. And from our side, all the best. And we speak to you guys again. Bye-bye.